Good afternoon, ladies and gentlemen. Welcome to the Q4 and FY21 Investors Meet of NXTDigital Ltd. On the management panel, we have Mr. Winsley Fernandez, Managing Director and Chief Executive Officer, NXTDigital Ltd. And we have Mr. Amar Chintopant, Whole-Time Director and Group Chief Financial Officer, NXTDigital Ltd. We will begin the call with opening remarks from the management as they discuss the company's progress in the digital platform space and their performance in Q4 and FY21. Following which, we will have the forum open for question and answer session. Before we invite the management, we would like to share a few guidelines for the smooth progression of the event. All the participants will be placed on mute mode. We will take questions post the management address if you have any. For any query or question, you may use the Q&A window to type your questions with your name and company name, or you may use the raise of hand feature in Zoom control panel. We will first take questions from individuals who have raised their hands by unmuting the respective participant to ask the question, and then we will proceed to answer the question in Q&A window. I would now request Mr. Winsley Fernandez to address the participants. Thank you, and over to you, sir.
Thank you very much, Banu. You can take this screen off. Good afternoon, good evening, every one of you, and thank you for bearing with us while we waited for others to join in. I'm sorry for the 5-minute delay. It's not a very good thing, but I appreciate it. Thank you so much. I'd like to start off by, on behalf of the NXTDigital and Hinduja Parivar, wishing you all a happy Akshaya Tritiya and an Eid Mubarak. It's a very auspicious day today, wonderful day with the onset of Eid after fasting, and as well as Akshaya Tritiya on the same day, so very auspicious day. I also want to hope and pray on behalf of NXTDigital that you and your families are all staying safe. It continues to be a very difficult period. I know my own colleagues and I have lost dear friends as well as family members, and it's a difficult time, but we are sure that like we have had resilience in the past to deal with this, we will all be able to come out of this stronger. And I wish any one of you or any family members of yours that is undergoing any kind of treatment or going through the affliction, I pray and pray for them, and I wish them a very speedy recovery. Thank you very much. Amar, would you like to add anything to that before I proceed with the deck?
Yeah, I would also just like to tell everyone that our prayers and our support is there, our emotional support is there with everyone. And please take care and stay safe, all of you. Thank you.
Thank you, Amar. So I have a slightly longish deck this time, and it's always very irritating, I know, on a Friday evening to have a slightly longish deck. But being the annual results as well as quarterly results, I thought I'll take you through it. So I don't want to spend too much time on what's happening in the industry, etc. But I have a single slide which I thought I'd share with you. There's very clearly a very, very bad year for the media and entertainment industry in India, right? Where you look at it, in fact, there's been a degrowth of about 24% in 2020. Segments such as television, advertising and subscription, which forms part of television, films and print, experiencing major decline. And the business that we are in, the television subscriptions business, which is one of the segments that we deal with, in fact, saw a revenue decline by about 7% in 2020. If you look here at the graph alongside, as well as nearly 2 million loss in cable television subscriptions. Now, these 2 million, you might want to ask, are they the 2 million that moved to free television? No, they are not. Free television grew its base, but the 2 million of cable television that was lost was effectively because of reverse migration, issues around disposable income and collection challenges. So there are people, for example, who had 2 TV sets or 3 TV sets. So they switched off the subscription to the second television, the third television. There are reverse migration that happened. There are hotels and institutions that chose not to extend it. Hotels, especially if you look at it, Andaman and Nicobar Islands, Darjeeling, Udaipur, Jodhpur, Jaipur, all the places which were popular destinations obviously had that there. But against all of it, the more difficult part was that the competition really picked up when, there was those phases of lockdown being lifted, and they discounted heavily to try to grab their customers back or try to grow their revenues. So we've seen discounting in the industry by as much as 80%, in fact, in the last 1 year. On the other hand, broadband, extended lockdowns that were there, saw an incredible increase in data and consumption, in fact, across all sectors, whether online education, etc. And segments such as digital social media, which is all your apps that you see, as well as gaming, etc., they really increased. So just 3 little graphics that I wanted to share with you. Demand for broadband went up in tier 2 and tier 3 cities. Very significant demand for broadband because work from home, online education. So there was about a 30% increase in time spent on educational apps in just April 2020 over Feb 2020, which of course went up even further. And while there was a 265% increase in OTT traffic, remember the base is very small. So 265% is not significant when you look at the overall scheme of things. And obviously, order volume growth in terms of online purchases went up big time. So that was one of the key things. So it's been a very difficult year for the media and entertainment sector. We looked at it, as I promised you when we spoke the first time 4 quarters ago, was that we will do our very best to accelerate our digital transformation and ensure that we stay ahead of the curve. So we continued taking a lot of initiatives in Q4 as well. I'm just sharing with you some of the graphs that went on and became very popular in Q4, where we encouraged cable operators, we encouraged customers to kind of, look at things differently, right? So for example, if I'll show you this one in the middle that my cursor is on, we encouraged people to increase their viewing experience, improve their viewing experience by migrating to high definition, right? And they were very happy to do that. We did this in a lot of markets using a QR code. We also created a Hangama package where customers who on standard definition, we helped them upgrade to high definition. This was so cable operators effectively pay less and earn more with long duration recharges. So we did a lot of innovative things across the board to be able to support and to be able to grow the business as part of the innovation matrix. As a result of which we got very, very significant coverage as well. Your company will be very proud has continued to have significant coverage. We've had some great firsts to our credit. Our broadband business was recognized as one of the fastest growing brands in 2021. Our broadband CEO, in fact, Yugal Kishore Sharma, I forgot to inform you, I apologize. Yugal Kishore Sharma, who's our broadband CEO, unfortunately couldn't be here today. I would have liked for him to be here. Yugal lost his father a few weeks ago, and therefore obviously is busy with the necessary family and others, and we are sure that he's here with us in spirit to support us through this activity, but he's not here today, unfortunately, to take questions. But during the week and ahead, we're happy for him to arrange face-to-face, one-on-one meetings with him. So we continued. Our group CTO, Ru Edrivira, was listed as one of the top 100 Wonder Women leaders in the advertising, media, and marketing space. Thanks to you all and my team that's here. We won the award for the CEO of the Year for the turnaround that we achieved. So I'd like to thank all of you for that support that we had. If you look at the business performance in Q4 as a result of that, what did we do right that allowed us to end up the year so strong, right? Our subscriber base continued to grow. We were able to grow our business, mainly if you look at it in the hit space, where we were looking at it, we were able to grow. Not just that, one very critical thing which I shared, I had an interview on ET Now. One of the critical things that reflects how strong the company's innovation has been is that our biggest base is subscriber base is in DAS 3 markets, right? Which is the purple line. We were able, in a pandemic affected year, we were able to grow our ARPUs, average revenue per user, take it from 141 to 151. Mind you, as I'm saying, this is the most significant base. Over 60-65% of our base comes from these markets. So when you look at that, it more than compensated for any reduction in ARPUs across other markets which were affected as a result of the pandemic and people taking lower packages. Not just that, I think the most incredible performance in this year is attributed to our broadband business. When you look at a YOY basis, Q4 of this year over last year, we've grown by over 87%. Incredible growth. Yes, we're seeing ARPUs coming down, but that happens because as a result of two things. One, the amount of usage went up, so you had that many more players in the market as a result of the lockdown. And secondly, as we expanded into tier 2 and tier 3 markets, the ARPUs tend to soften up. So anyways, that was more than compensated by the fact that we were able to grow our base by about 87% year on year and quarter by over 19%. In fact, just in the last quarter alone, our broadband business added 100,000 subscribers. That is an incredible performance, and it reflects how all the businesses that we have, our video business, our hits business, cable television business, hits business, broadband business, all the shopping, all of it came together to form a very strong platform in this year and grow the business. In terms of net churn, we did, I will put my hand on my heart and admit it was a challenge. We weren't able to achieve what we would have liked to achieve in terms of net churn, but that was more than compensated by the same month's renewal, which as I've shared with you all, and if someone has a question on it, please feel free to raise it at the end of the session. I'll explain the concept of same month's renewal and on-time renewal, two KPIs that we look at. The good thing was that improved, right, in the quarter. So that went from 91.3% to 92.6%, and that in itself showed a very strong performance. Sorry, I'm just struggling a bit with the cursor. Yeah, right? So effectively, the KPIs reflect the company focus on building a sustainable model. Last year, a lot of my colleagues, you all who are on the call today, analysts and investors, had this question that you've turned around the corner, right? You've turned around the corner. Will you be able to sustain this growth model through FY21? And I think quarter on quarter we've proven that even against the challenge of pandemics, of the pandemic that was thrown at us, we were able to do it. This is effectively represented in our revenues, where if you look at just our revenues, we've been able to grow quarter on quarter in terms of revenues by just under 7%, and on a YOY basis by over 22% in terms of revenues. Not just that, in terms of EBITDA, we've shown a very healthy growth of 8% QOQ, and Y on Y has been an incredible performance as we've crossed over 150%. Not just that, I think one very important thing that I'd like to share with you is that we've continued to focus not just on growing the top line and at a certain cost. We've looked at how also do we improve our profitability. And that is reflected in our EBITDA margins, which have improved from 11.1% for last Q4 of last year to 24.3%, which is even marginally better than Q3 of this year. In terms of PAT, we maintained a very, very strong performance. As Etina was saying, it's a 30x improvement in terms of PAT that we've been able to achieve, showing a growth of 131% over last year. And as well as on a QOQ basis, we've been able to perform very strongly. And subscriber debtor days, which again I've shared with you all in the past, is a very important barometer because a lot of competition you will see will show revenue as accruals. For us, it's all prepaid, it's all cash collection, it's all upfront. So the beauty is that even on that basis, whatever nominal monies that we had to collect that would be there was less than 1 day and less than 0.2% of the total revenue that we had. If I look at the full year performance for FY21, I want to start with one slide and spend 5 minutes on this one, please. We were faced with the pandemic. We knew that we had to do something innovatively. We knew that we had to change the game. We knew that we had to look at our business. But one thing we were clear, we were never ever going to allow ourselves to sacrifice the safety, the health, safety and well-being of our teams at the altar of any profitability or revenue. We worked together as a team and we said, listen, what is it that we can do differently to help the industry grow, to help our business grow, and at the same time ensure that we keep our entire ecosystem all the way to our subscribers safe. So what we did was we accelerated our transformation to an all digital services company, if you look at it. And how did we do it? We did 4 or 5 interesting things. We rolled out a digital work from home solutions package. What is it? It meant that customers could now get a single one window package that included television channels, which included, of course, the critical news channels, value-added services like educational channels, which became, by the way, very popular in rural India. We had a lot of education channels, we still do, and high-speed internet that we provided to our customers. Not only that, we saw that there was a great opportunity for broadband, and the idea was rather than chasing broadband, mindlessly, we had a very clear strategy of leveraging the broadband capability of the organization to optimally cater to the surge in demand. So we went on an optimal basis rather than having to invest across the board. And that saw us achieve a huge growth of 87% in the customer base alone. Then when we looked at it, we also saw consumer demands were changing, consumer, thought process in terms of were changing in terms of content. We worked with the broadcasters and our last mile partners, and we were able to change content packages. We launched, for example, I was sharing with you earlier, the all HD content packages. We had kids content. Then in small town India and rural markets, sir, we can't really afford it. Is there some kind of cheaper package that you can do? Our packages went down to, at the cable operator level, went down to around 40 rupees, literally. So it just covered our managed service fee, and it covered a bit of content, paid content that we were doing. The rest all came from the fact that we wanted to ensure that our customers were never affected by the pandemic, and that is a matter of great pride that we've been able to do that. And that was reflected in ensuring a strong business continuity plan. We wanted our staff to stay safe. We wanted our customers, our subscribers to stay safe. We launched a couple of initiatives like, for example, which is the next line, in fact, 100% digital mode of payment. So customers could pay our operators digitally and therefore in a contactless manner. Today, the best part is, and I say this with pride, nearly 100% of our revenues come through this prepaid model and through this digital payment model. So that reflects the kind of sustainability that we built for the future. And all of this was backed by the unstinting and tireless efforts of our teams. Our teams, while they took all precautions, wanted to ensure that children never lost their education, right? People who were working from home never lost connectivity. Entertainment was always available to the home. And more importantly, everyone had the services that they would have in a normal circumstance. That clearly has really put us on the track to having a very, very strong performance in this year. And look at it. In terms of the subscriber base, we've been able to achieve a 2-year CAGR of 18%, a growth of 10% year on year. That is very significant in a year that has been affected by the pandemic. And that only reflects our transformation into a digital technology services company. If you look at ARPU, again, as I shared with you, very significant growth. From 129 rupees way back in FY19 that we would be pegging at. Today we are at 151, which is significantly higher than the 144 that we earned last year in terms of ARPUs during a happy year, if I may call it so, right? And then, of course, the hero of it all that we believe is our broadband business. As I just shared with you, we've seen a significant growth, 80%, 87% growth in terms of the subscriber base year on year, and a 2-year CAGR of 75%. So all the cylinders, all the levers in the business that we had, all came together as one energized ship to be able to deliver. And while we looked at revenues and we looked at KPIs, we also looked at how are we controlling our back end. And there too, I'm very happy, ladies and gentlemen, to share with you, even our broadband costs, our subscriber acquisition costs, which at one point in time was over 2,000 rupees in FY19. If you look at it, it's better than even the industry average by a long shot. We're down to about 1,149 rupees subscriber acquisition cost in FY21. So that is a matter of great pride for us. Same thing in terms of our same month's renewal and our one-time renewal, same month's renewal, we had a challenge during the year, but we more than compensated it with our on-time renewal. So there was a very strong balance that we had. The only place where I personally, where it's a personal thing for me that we probably could have, we weren't able to achieve our target was the 90-day period. It kind of dragged on longer than that. But yes, I know it's a nominal, percentage, less than 0.2 percentage points. But as a company, when we set ourselves very, very high standards of performance and very, very high KPIs, we feel that we should have done better on that front. But irrespective, the transformation into a digital services company reflects how we've leveraged our product portfolio across group companies. And again, this is reflected in our financial performance team. So we've been able to do it and focus on our digital transformation. If you look at revenues, we have maintained our top line of our core business, right? There is this nominal drop of about 30 crores on a year-on-year basis, which is nothing but attributed to the low margin volume trading business. Amar, if I can request you to explain about the trading business, because clearly our core businesses kept on growing. It's the trading business, non-core business, which contributed to that particular revenue piece, right? So if I may just request you to.
Yeah. Sure, Vince. So one of our lines of business, one of the subsidiaries that we put it has got a trading business. It's an online, it's not an online trading business, it's a teleshopping trading business. So during the pandemic, and it's a low margin business, it really doesn't contribute much to our bottom line, but it is something which we would like to be present in because that gives us a connect to our consumers. So it's a low margin business where we'll probably earn about 1 to 1.5%. That business took a beating during the pandemic. And consciously also because we did not want people going around delivering those goods and things like that. So yes, that business actually dropped down by about 40 crores. That's just what we see. And therefore, it's not impacted our profits in any way. It's just impacted our top line. Our costs also have correspondingly come down. Right?
Yeah. Thanks, Amar. And Amar, you're right. I mean, the fact that it doesn't contribute significantly is reflected in the EBITDA, where we've been able to grow our EBITDA year on year. Again, I repeat, in a challenging period of COVID, when the entire performance of the industry was challenged, we were able to maintain the turnaround that we achieved last year, and we were able to grow our revenues, grow our EBITDA again by about 6% year on year, 6.18%. And I think the other thing was we didn't sacrifice performance, we didn't sacrifice profitability at the altar of growth or the altar of wanting to grow our revenues radically. We focused on our business like a strong digital team, saying, listen, we know our business best. Let's focus on the key areas. And I think that's reflected in the fact that we were able to achieve or improve our EBITDA margins in this year from 21% last year to 23% last year. Even in terms of the profitability, we've been able to have a stable profitability aspect. Again, reflects very, very strongly in the fact that the team was able to maintain the stability against the challenges that we saw. So, just summarizing it, the overall performance of your organization has stayed very, very robust. We've been terrified by reports that have come in where the Indian media and entertainment industry has seen a degrowth of as much as 24%. Subscription has dropped down by 7%. Against this challenge, we've been able to grow on our revenues on a strong note. If you look at Q4, quarter 4 of FY21, we've registered a year-on-year growth of about 22% in terms of revenue, and in terms of EBITDA, over 150%, 167%. So that reflects the fact that the company has very clear focus on what its product portfolio should be, what its digital transformation should be. And broadband, as I said, played a very, very pivotal role. With an 87% growth in subscriber base, it will continue to be a significant part of our business going forward. And all in all, while our core businesses remained stable throughout the year and our revenues remained stable, our EBITDA for the year saw a growth in FY21 over FY20, as I mentioned, of 6.18%. So that, ladies and gentlemen and friends, is the performance. I don't know if I rushed through it, but I'm hoping that I didn't. I was trying to keep it as crisp as possible since there are other slides. And I'll go on into the next slide, which is very important, and I'll take questions at the end, is what is the growth drivers for FY22, right? Where do we go from here, right? We've leveraged our business. We've been able to work out our teams. We've been able to integrate our businesses. I think there's a great opportunity ahead for television. A lot of people in the past have been unkind and kind of mentioned that, television is not growing. And interestingly, the truth and as they say, the truth lies in the data somewhere, right? And television is expected to grow. It's expected to go back to its 2019 levels. It's expected to go back in 2021. The fundamentals of television remain very robust. And if you look at it, everyone spoke about OTT. OTT has not impacted television as much as people thought. And that is evidenced in the data, right? During the lockdown, we've actually seen general entertainment channels or news channels, we've seen their viewership actually improve and increase. India still remains underpenetrated. There is no question about that. We're talking about there is a gap still of anywhere between 40 million households to 60 million households. And I'm not talking about households below the poverty line. I'm talking about 40 million to 60 million households, which will make the transition into television and will make the transition into digital. So that is bound to happen. And if you look at the EY report, TV subscriptions will continue to grow. If you just look at this graph here, the prediction, this report came out in March, is that pay television, which is cable, DTH and hits, is expected to continue to grow between 2020 and 2025. And there's one more segment here, which I'm sure all of you all as sharp as analysts must have picked up, is the connected TV, bi-directional TV. This is the other opportunity for companies like NXTDigital, where we have a digital solution service and are able to leverage that opportunity. So that's another great thing. And I also looked at the Media Partners Asia report, right? When you look at the rest of the world, India's pay television sector remains a high growth outlier amongst major markets, right? If you look at it, if you look at the growth in the next 5 years, the $6.7 billion that will be added that will be India's contribution or growth in terms of video revenues across the Asia Pacific region. Interestingly, 53% will be attributed to television and 47% to the non-television, non-linear digital streaming services. So we're very happy that is a great opportunity for us. Similarly, in terms of broadband, very interesting, even though broadband grew significantly, and if you look at this TRI report that was issued in January 2021, even today, wired internet subscribers in the country is only around the 20 million mark, right? And it's growing probably. We believe that is the kind of opportunity we have because we have our own video base, our own cable television base, our own hits base. How much do we further grow our base through integrated product offerings of broadband and video? So this is a great opportunity that we see because penetration is still less than 8%, right? And if you look at fixed line penetration, 90% of the subscribers are still on copper. So that is the other opportunity that is there. So we believe that there is tremendous amount of traction in terms of how the business grows. So we as NXTDigital, and I'm sure a lot of you must be asking this question, is that what are your key growth drivers? So this is a great motherhood statement that we will grow in broadband, we will grow in the video side, but what is our focus? Our focus, I want to share with you for this year, one of the key drivers will be our newly launched platform as a service offering, PaaS or infrastructure sharing. As most of you all know, we received our permission from the Ministry of Information and Broadcasting on April 14. And we're very grateful to the ministry for considering it because it will now follow like the telecom tower sharing model of the late 2000s. We'll now see, instead of tower sharing, we're now going to see satellite sharing. We're going to see. And NXTDigital is the only company, just for your information, that has received the permission to do so and has been, and is the only one that can actually provide it to other multi-system operators. While we had estimated about 69 million being the universe, we wanted to be a little cautious of it, and we believe that 60 million is the kind of opportunity that we are looking at. And as NXTDigital, we've seen already the benefits. Now this is going to change, is a game changer, ladies and gentlemen. Why is it a game changer? Two conventional competitors who have been fighting with each other across the country in terms of ground base, etc., have come together to share infrastructure. When that happens, all the other multi-system operators are going to say, why can't I leverage the opportunity? And why would they do it? They do it for a couple of reasons. One is that they could reduce their connectivity costs, which by the way is the biggest cost head today after content. One is they could reduce their connectivity costs by as much as 50%. That is significant. Number two, they don't have to invest in technology going forward in terms of expanding their offering. Take an MSO, let's say, I'll give you an example, Chhattisgarh. He's set up head-ends, he's set up everything, but he's delivering 400 television channels to his customer. Now, if he chooses to use our infrastructure sharing model or PaaS model that we have, number one, he reduces his connectivity costs by over 50%, by up to 50%, number one. Number two, from suddenly 400 channels that he's giving his customers, he can now give them 700 channels because he gets full access to our spectrum. And number three, his quality of service improves because there are no longer fiber cuts, etc., because this is satellite delivery service. So the kind of potential opportunity that we have in this business model is incredible to grow the base. And we believe that it's not just the reduction of costs or cost per subscriber that will go down, but more importantly, the MSOs are also realizing that here's a model that all we're doing, we remain independent. We're not selling out to a NXTDigital PaaS platform. We're completely independent. We're running our business independently. We're continuing the way we work. We have our own back-end systems, our own set-top box, everything. All we're doing is we're sharing NXTDigital's HITS satellite delivery service to deliver our signals, right, seamlessly to customers. So if you look at it, it's an incredible win-win situation for NXTDigital because what do, right? What is our view on this business? Our view is very simple. The capacity has been set up to support millions and millions of customers. It's like saying that there is a satellite up in the sky which has 700 channels and millions of customers, even up to 60 million customers can do it. So there is no further investments from NXTDigital side. We don't have to invest in capital expenditure. We don't have to increase our operating expenses. All we're doing is the assets that we have invested in, namely our HITS infrastructure. We're now sweating those assets by allowing others to use the infrastructure which already exists up on the sky. So we're very, very happy that this model, and we're very grateful to the Ministry of Information and Broadcasting, especially in a pandemic year where they understand that it's important for MSOs to look at reducing costs. And by doing this, and we're very grateful to City Networks, our anchor customer, for having the faith that by working together, we have nothing to lose and everything to gain. So it's a very proud moment for us as an organization. And we hope that to see, and by the way, we're talking to other MSOs and we'll inform you and the media as and when we sign those agreements, but they're all in advanced stages because there is now a comfort that if they can do it, why can't we? So we're very proud that there are others who are approaching us. So this is the first big driver that we believe, and a first announcement that I wanted to share with you, right? And we've got tremendous amount of coverage. Your company has got coverage right across the board in terms of this because it's seen as an industry first fact for infrastructure sharing. So we're very happy that this is going to set the groundwork for the future. In addition to that, we've got clearly 6 drivers for our business model. The first is, and I'm sharing this with you, I do apologize for limiting the information that I share because there's a lot of it that we're working in strategically. We are looking to expand our presence. Currently, our footprint is 1,500 cities in India. Our idea is, how do we leverage smaller towns and markets where cable operators can't necessarily invest in this cable operator premise equipment? So we are looking at setting up 100 owned and operated points of presence. It's not a significant investment is the best part because most of it is already at the back end already invested. But we're looking at expanding our footprint to over 100 new markets where we will be able to get, if you look at markets anywhere between 3,000 to 4,000 customers for those markets. So we're very keen on seeing how that model shapes up. We've already put in place a project management team. There's a lot of work that's done. And this model of 100 core plan will not just increase our footprint, but it will also eliminate the cable operators' investment in corps. And from our side, it's not putting in a full head end. It's all we're doing is putting in a point of presence, like a plug and play, saying here, it's like an ATM. I think that's the best way to describe it. It's an ATM. Here's an ATM in your town. It doesn't matter which multi-system operator or cable operator you are. All you need to do is come into that ATM, plug it in, and take your connection. So this is a model that we are rolling out. We will focus on new markets and subscribers to new products. We are in the process of rolling out a very strong hybrid set-top box with an OTT platform. Some of you who are on the call have actually seen it being tested in play, and we hope to roll that out shortly. Infrastructure sharing, I just shared with you. The potential is over 60 million customers. We are looking at leveraging that and stand by, as they say, for exciting announcements in that space. We are looking to grow our broadband base. We've seen incredible traction that we've been able to achieve over the last 1 year. We've seen how our video business and our broadband business is strongly integrated, and we believe that it will work beautifully. We will look at growing also SAP. SAP is a strategic alliance partner where we partnered with smaller operators to help them grow their models and grow their businesses. So there's a lot of unique, innovative thinking that we've done in this last year. Another thing that we have is our enterprise business. We believe that the future is going to be single window solutions. So imagine going to a customer and saying, here's a complete buffet of services, rather than you having to deal with multiple vendors, multiple solution providers. You don't need to go to a different person for video, a different person for broadband, a different person for fiber connectivity, a different person for CCTV, a different person for IoT devices. Here's NXTDigital, who will bring all those partners to a common table and be able to offer the solution and stand in front and take the responsibility for it, either on a wet lease model or a dry lease model. Again, we've hired a head of enterprise business unit. We've been working very, very hard on building up the team. We hope to see traction on this soon. And the last driver is something that we're working on, which is new initiatives. We saw during the pandemic one important issue, and I want to share with you. It's not a great feeling looking at it. We saw that while delivery of products and solutions were easy in tier 1 and tier 2 markets, we saw that tier 3 and tier 4 markets faced a challenge. They faced a challenge of even basic essential stuff probably reaching them. So we want to work. We've got 10,000 cable operators in the most rural markets going and the most far-flung markets, including Andaman and Nicobar, far northeast of India, Lakshadweep, Kargil, Ladakh. We're very proud of those areas. The idea is, can we use them to actually become the delivery agent for essential products and solutions and services? And we're already looking at developing that market. The other thing, which is something that I don't want to talk about too much now because we're still working on, is leveraging the content business into a separate, strong vertical for monetization. We've got multiple content assets. As you all know, we own the rights to over 500 films. We've got serials that we made in the past, television serials. We've got all of that in place. But the one thing that we've not done is leverage it in terms of monetization. Again, we're in the process of hiring a digital head of content who will work on this. So this, ladies and gentlemen, is the presentation. I have one last slide, which I want to share with you. I promised you, as I did last time, that I'll try to keep it under 45 minutes. And I think you guys need to reward me for doing it. I may 5 minutes more exactly for the last slide. So what is our vision for FY22? Where do we go from here? There are 5 key things that we believe will be important to play for us. The first, as I mentioned to you, our serviced customer base. The beauty is that all we need to do now, the infrastructure is invested in, the facility is there, the satellite service is there, our broadcast center is there. Without having to invest a single rupee, all we need to do is bring MSOs to our platform, charge a fee income, they go live. For them, they reduce their cost of operations. For us, we earn a fee income. Opportunity, over 60 million homes. What are we looking at? Over the next few years, we would certainly like to look at providing this PaaS service to competitors, to peers, to others. And we'd like to have a sizable market of about 30 million serviced homes going forward over the next few years. The second thing is, as I just shared with you, our core business, we've got a very clear strategy for that. If you see, someone asked me last year, what is the strategy? And I said, listen, unfortunately, strategy is one thing that you don't necessarily share. But I want you all to remember that what we promised last year, has been evidenced in FY21. We have been able to grow our core business. And the 100 Core project, as I mentioned to you, if you look at it, our hits business and our broadband business, working as one, will look at making inroads into these 100 new markets, more than that actually, but it will look at proliferating newer geographies. That is the second big vision pillar that we have for this year. The third thing is improving top lines and margins. Again, interestingly, as I said to you, every revenue rupee that we earn from our platform as a service model goes straight to our bottom line. The unit economics are very simple. We've invested in the hardware and infrastructure. We've invested in all the satellite infrastructure. It's now time to sweat the assets that we've invested in. Every customer that comes onto the platform, everything that we earn goes straight to our bottom line. Are there any investments? There are no investments in capital expenditure or in operating expenditure. All they do is, it's like an ATM. Someone plugs in, takes the service. And innovation, I shared with you, we are looking at new digital solutions that we have. And while we're doing all of these business initiatives, and I'm not even allowed Amar to speak on two important matters, and I request him to do so now. While we're doing all these initiatives, the important thing as an organization is growth, wonderful. Improving bottom lines, wonderful. We need to do that. But I think as a company, we've also worked in the last 1 year, as we promised you last year, we're also going to work on the fundamentals and the capital structuring of the company. That is something as an organization we have never lost sight of. We have had initiatives over the last year, and we have plans for the future. And for that, I'm going to request Amar to spend 5 minutes on that, Amar, and to also mention about the dividend aspects for the year or any other financial aspects that you think relevant. Thank you, Amar. Go ahead.
Sure, Vince, thanks. So if you'll recall, when we started off these presentations in the last year, in October of last year, one of the questions which came in and for which we had an answer is, the debt on the balance sheet is very high. What are you going to do about it? So we had said that we are working on two solutions. One is an asset sell-off to sort of realize money out of assets which were not giving us any income, use that money to pay off debt. And second one was a capital raising. So in October of last year, we had even set up a committee to look at various options. And even from the investor community, there were many suggestions which came in. Maybe you have to look at M&A, maybe you have to look at a strategic investor, maybe you have to look at a rights issue. Various suggestions also came in. So the first step we did was on 30th of October of last year, we sold about 100 crores of shares of Hinduja Railway Finance, which we had. That money was entirely used to repay debt. So that was the first step that we took. The second step we are taking now is the rights issue. The rights issue size is roughly about 300 crores, as you may all have read. So why this rights issue today? If our debt to equity is roughly about 3.8, so our net worth is roughly 250 crores, and our debt is about 950 crores. So this translates to about 3.8. What does this rights issue do? The rights issue straight away reduces our debt because we would like to use the money to sort of rationalize the debt that we have. But even if you take the full amount, so on an arithmetical basis also, the 950 crores will actually come down to 650 crores. And the net worth will go up from 250 crores to 550 crores. So over a very short period, we are able to sort of bring down the debt to equity from a 3.8 to 1.18, which itself is a significant thing. Not only does it bring the debt equity down, it will even save us about 30 crores of interest outflow per annum, because even if you take an average cost of 10%, we're talking about a 30 crore interest outflow during the year. So this is the second step. The third step that we would like to do, I would rather put it, for which we have been thinking, is the land assets that we have. These are not productive. We are a media company. We do not need real estate assets. So what we are carrying in our books at 37 crores, today the value is roughly about 250 crores. So that probably would be the last leg of the balance sheet restructuring exercise that one would go. And if we raise about 200 to 250 crores, that again will go to sort of rationalize our debt. So I will be sub 1. at that point in time. What does the sub 1 help us? It definitely helps us to sort of bring debt to equity at a levels where it actually is giving us a platform for future investment for growth, right? So that's where we are today, and I'm glad that we have been able to show progress about whatever we had committed in the past. We've been able to show you progress in these areas, right?
Thank you, Amar, very much. Amar made one point, and I want to just touch upon it before I go into questions and answers. I think the fundamental for any organization is good governance and is a strong plan. I think the idea is that we made certain commitments and certain information that we shared with you. We've done our darndest best to do it. As Amar pointed out, we've already taken steps to that effect, and that reflects, I think, the fact that we want this organization to complete its transformation, not just to a completely digital services platform or a digital technology company, but also grow in stature as an organization. So we're very proud that we've been able to build in those benchmarks that, as they say, sometimes separate the men from the boys. So thank you very much for hearing me patiently. Like I said, 45 minutes, so I've been able to beat the clock. Amar was the one who took all the time. Banu and Snyder, if with your permission, can we proceed to the next stage, which is the question and answer?
Sure, sir. Thank you, Winston sir. Thank you, Amar sir, for the insight. We would now take questions. We would request all to use raise of hands or type in your questions at Q&A windows. We have 2 raise of hands. So we'll start with Miss Urvi. I would request Miss Urvi to unmute herself and introduce herself with her name and company name and ask the question.
Hi, my name is Udbija. I hope I'm audible.
You're loud and clear, Udbija.
Okay, great. So congratulations, sir, on your result and the press note for the tie-up with the City Cable for sharing of the infrastructure. So I had follow-up question on that what will be the revenue model that we will generate that will be for sharing of this infrastructure?
Sure. Urvija, thank you so much. First of all, thank you, Urvija. We appreciate your words and sentiments. It's thanks to things like that make us feel good that the efforts are all worth it. Amar, would you like to talk broadly, or would you like me to take this on?
Whichever, I can broadly mention it.
How it works.
So basically, this works as there are 2-3 models, but as far as, since you asked a question about city, we can restrict it to the city. So this will basically be charged as an amount per subscriber of city. So we will have a complete track of how many subscribers have sort of moved from their existing traditional base to the HITS base. So for each of the subscribers that connected to us and to whom the signals are provided, we charge a per subscriber rate to city. Okay, this is not matched with what rates we get from a full content provision, because this is pure infrastructure sharing. So these rates vary. These rates vary from volume to volume of subscribers that we get. And in the initial period, some people we may charge higher, and as the volumes increase, the rate will go lower. So coming back to your question, the revenue model is a rate per subscriber that migrates onto our platform. I hope I've answered your question.
Right. Sir, are we in talks with any of these bigger players like Hathway or Den for this infrastructure sharing? And you elaborated that with City, it is per subscriber base. But what are the other, you said there are a couple of options. So what are those options?
See, sir, we have not restricted to say that you got to have X million of subscribers. We are even looking at providing to 50,000 base, 100,000 base. So in which case, we put a minimum amount. Right? So we said you have to give us a minimum amount. And then if your subscriber base grows, many a times it may not grow. See, because digitization has reached a stage where organic growth goes slower than it used to in the past, right? So therefore, you cannot, because they may lose subscribers. Let's say somebody has got a 50,000 base and I put a per subscriber rate. Then if the subscribers come down, one may end up losing. So there we put a minimum rate. So that's a fixed charge per month. So the other model that we have is a fixed charge model per month. Sometimes what we'll say is they come back and say, this is our cost. Can you reduce our cost? Let's say somebody comes back and says, my cost is 1 crore. So he says, can you reduce our cost? So we work out and say, okay, if your cost is 1 crore, it will benefit to you only if you bring it down by say 30%. So we fix it based on that. So these are the different models which we have been working on because the industry itself is different. There are different kind of MSOs, different kind of revenue models and things like that. So these are the different structures that we have put in.
Vijay, I hope that answers your question.
Yes. So are you in talks with any other operator for infrastructure sharing, or
Yes.
if you can?
Yes. So Urvija, we are in talks. We are unfortunately bound by the non-disclosure agreements that we have with them because it's not just the larger players, not just the pan-India players, but it's also smaller players as well. City Networks, as you know, is one of the biggest players in the top 5 as well. And we're in talks with others, Urvija. We would be making some announcements soon. It's in the last stages one can call. See, also, Urvija, just to tell you, the way it works is that it's not just discussions. There's a lot of technical testing that also happens to ensure that there's a sync, everything works perfectly, the back end works perfectly. So we do a lot of technical testing. So a lot of that is currently going on with nearly 4 players even as we speak.
Okay. Sir?
Ma'am, may I request you to again raise your hand and come in the queue till we answer?
Yeah. So, Urvija, may I request you? I see one very upset. Manoj, are you still on? Manoj, are you there? Manoj?
Yes, sir. He's there, sir.
Manoj?
Sir, I'll just allow him.
Please. Sorry, Urvija. I'll get you back again because I understand Manoj had to leave.
Mr. Manoj, may I request you?
Are you there, Manoj?
Mr. Manoj, may I request you to?
Hi, Manoj. How are you?
Yeah, I'm fine and good to see your face again. Two things. One is I had to leave for another larger company meeting and also for a personal meeting in BKC on essential services.
Right.
But 2 points. One is you talked about tie-up with the Z Group company.
Yes, Manoj.
I would like to know, and also you said other talks are in negotiations. I would like to know very clearly, and I also saw your interview on the ET Now, which was actually not very clear. But I would like to know very clearly, what is the impact of such a deal? Is it a material impact? That means about 5% impact on top line and EBITDA, or is it a significant impact, maybe 10, 20, 25% on top line or EBITDA, or it is insignificant, just a marketing gimmick announcement from that PR angle? How do we look at it? Second point, last time, in fact, last 3 meetings, I remember our conversations have been going on a deeper level. And last time you said we will meet 1-to-1. Is there a timeline we can do? Can we meet today or can we meet this week? Otherwise, if there are no meetings and we commit and we are not able to have your numbers also.
Manoj, I personally apologize to you. Let me tell you what happened, and I'll be very honest with you. I was setting up these meetings earlier. Unfortunately, I'll share with you now on a personal front. My wife and I were down with COVID. I was not in the best of shape, and I'm still, kind of getting there. But just today, Snyder spoke with me, and I promised.
Well, let me tell you, health as well. Please take care of your health, not only yourself, all employees and customers. But there should be some communication.
We will
just a token communication, we can hold on. Otherwise, we don't know what's happening.
In the coming week. Now, as far as it goes, in terms of the material impact and how the business works, Amar, would you like to take it? Then I'll explain.
Yeah, sure.
If you want to give a subscriber base number.
Yeah. So, Manoj, good afternoon. See, the thing is, while it may or may not have a material impact on revenue, it certainly will have a material impact on EBITDA. Why would I say that? Let's assume that 1,000 crores is the revenue, and let's assume that somebody gives us a business which gives us a 20 crore revenue per annum, right? So 20 crore revenue per annum on 1,000 crores is 2%, but the 20 crores is a straight addition to our EBITDA. Correct? So if you have a 200 crore EBITDA on 1,000 crore revenue, and you get a 20 crore revenue, while the 20 crore revenue is just 2% of your revenue, it's a 10% of your EBITDA. So material or non-material is more particular with respect to EBITDA than probably on the top line. Because all the costs are already being
no
incurred.
significant incremental cost to this, correct?
No, there's zero.
No, nothing
Operating
at all.
leverage.
So,
You are
Manoj,
having operating leverage, correct?
That's right.
absolutely. So Manoj, let me explain let me take Amar's model a little further, right? Assume there's just 1 million customers that sign on. 1 million customers into 10 rupees, right? That's 10 rupees per subscriber per month. That's 10 million rupees, right? That's a crore. That's 12 crores just from 1 million subscribers. Where does that 12 crore go, Manoj? The 12 crores sits straight at the bottom line because there's no investment that NXTDigital has to make either on the satellite capacity, on the technology, on the operations, nothing. Where we have the leverage of negotiating everything north of 1 paise as a good deal. So for us, the way we negotiate, and Amar made a point, very often one of the partners and one of the potential customers, in fact, has come to us where he's saying, don't work on a model of per subscriber basis. Here's my cost. I'm spending 2 crores a year on 12 crores a year on connectivity. How can you help me? Can you reduce my connectivity cost by 50%? Right? And in fact, I alluded to that even on the interview that we were mentioning about earlier. That's where the 50% comes in. Now it's up to us to do a back calculation and say, listen, 50% means 6 crores. This is his customer base of 10,000 or 1 million or whatever. This is what it works out per customer per month. For us, it's not really a cost per sub that we have. So for us, it becomes a back calculation. So we look at the revenue as flowing directly to our bottom line in this business, which is why it makes this announcement very significant. Because imagine, just imagine a kind of base. Imagine a 5 million base. A 5 million base at even 5 rupees, right? That's 2.5 million. That's 2.5 crores a month, right? From one single customer. Now imagine multiplying that by 2x, by 3x, by 5x in terms of customers. Why is it a win-win? Because while I'm earning a fee income, NXTDigital is earning a fee income from sweating its asset. Why would the MSO want to join us? The MSO would want to join us because his connectivity cost, which currently is 20 rupees or 20 or 18 rupees per customer per month, he's negotiating with me for 9 rupees per customer per month. So there's a savings of up to 50% for him. So it becomes a win-win for both. There's a saving for the platform customer and there's a great earning for me. But for me, every rupee I earn north of 1 paise goes straight to the bottom line because there is no investment that I need to make in the infrastructure that we built, which is why the terminology and which is why the Ministry of Information and Broadcasting refers to it of sharing the existing infrastructure of the platform, right? So, and we are the only ones today in the country to have received the permission for that. We got our permission on April 14th, just a month ago actually to date. And we signed on with City Networks, who's a very progressive company. They believe that it's great for two competitors to work together. We've been able to work out a strong model with them. Similarly, there are other such MSOs who are coming forward now saying, because suddenly they realize, like the telecom business, that I can share towers, right? If I'm able to share mobile towers, why can't I share this infrastructure? I'm going to the same markets. I have the same channels. In fact, the number of channels are increasing if I partner with NXTDigital. So overall, this PaaS model is going to see major traction over the next 3 or 4 quarters and beyond. I'm talking about 3 or 4 quarters because in view of the fact that we've got our approval last month.
Mr. Fernandez, the way you and Amar are articulating now, I wish, I don't know to how many channels you have gone across, possibly the CNBC and others also. So if you articulate this, the way you articulated now, and Amar mentioned about operating leverage, clear impact is significant. That should come across because that is not coming across now. This means it's a major strategy going forward, right?
Absolutely.
That's one of the deals. And if there are no incremental cost, and then it can change your business model, which we need to understand more deeply, which I think you are saying we can have a physical meeting within a week, correct?
Absolutely. I'm happy to do that. I've always been happy to have meetings, because it's nice like this, like you said, very often sometimes on a phone call or whatever, we're not able to articulate. I'm someone, Manoj, just to tell you, who likes using a whiteboard, right? So I like this. Amar's laughing.
So do it because some of the people who are not willing to give me your WhatsApp number or SMS, so I can send you
I
two questions on
will
the
do
chat.
it right after this call, Manoj. I won't hold you up now any longer because I know you need to go to BKC. So
Yeah.
I kind of asked them to jump the queue for you. So I apologize to everyone else that held their hand up. But
That's okay. Thank you very much and wish you all the best in creating proper transparency. I hope you upload this conversation on the BSc NSE website. That will help you clearly.
Thank you so much. Thank you
so much. All the best.
Thank you.
Banu, can we go back to who had put up their hand after Urvi?
So, we have a raise of hand from Mr. Dikshit Doshi. Mr. Doshi, I would request you to introduce yourself with your company name and ask the question.
Thanks for the opportunity. Can you hear me?
Yes, Mr. Doshi. Good afternoon to you, sir.
I'm Dikshit Doshi from Whitestone Financial Advisors. So, thanks for the presentation. Firstly, just a clarification. So, you articulated it quite nicely with the deal with Citi. Can you share the so you mentioned that it will be a per subscriber per month kind of fee, but can you mention how much it would be? And also, you mentioned that the connectivity cost of the MSO will come down to half. If not the deal with the city, can you comment on how much would be the connectivity cost as of now for any MSO per subscriber per month kind of metrics?
Okay, so I'll deal with the second half of the question. The first half I'll leave to Amar, who's my conscience to share that. So let me put it to you. Mr. Doshi, let me give you a specific example, okay, of a connectivity, right? So there is a location called Narela, okay, which is a few kilometers away out of Delhi. Now, to deliver, you may just have that particular MSO has 3,000 customers there. Okay, but those 3,000 customers have a choice of multiple channels. Someone has high definition, you can't decide which customer is which package, right? It's dependent on the customers. So as far as you are concerned as an MSO, you have to provide a fat pipe to Narela. So the cost of the fat pipe, you also need a redundancy, works out to about 36 lakhs a year. Now, if you look at 36 lakhs a year and you divide it by the number of customers that you have there, your connectivity cost per subscriber per month, after you adjust everything, works out to 17 rupees per subscriber per month, right? That is how the connectivity cost comes in. And you have to keep those pipes on, right? Irrespective, if the number of channels increase, you may need to increase the size of the pipe. Number one. Number two, your connectivity gets affected because whenever there is metro work happening or whenever there is any kind of infrastructure work, it tends to affect the connectivity. Now, look at the fact that you as that MSO decide to move to NXTDigital. You move to NXTDigital, what happens? NXTDigital says to you, listen, you don't have to worry. You switch off those two fibers that you have connecting, switch off the terrestrial links to Narela. All you need to do is put this refrigerator size equipment in Narela. They put it in there and suddenly, as against 600 channels or 500, they're now delivering 750 channels through satellite. What do I have in my leverage, operational leverage to negotiate? I look at it and I know what his connectivity cost was. And I said, okay, listen, he was at 17 rupees in Narela. Listen, he's happy to reduce it by 10%, 20%, 30%, 40%. So I can set up any price, right, south of that or north of 1 paise. So I can do a deal and say, listen, I can do it for 10 rupees. I can do it for 11 rupees. I can do it for 15 rupees. I can do it for 4. It's the size and scale and volume of the business and the potential of the relationship and engagement that will define the pricing structure. Because there is no cost unit economics attributed to it on the basis of which I need to set a particular, MRP, right? I don't need to do that because I'm sweating an existing asset, Mr. Dikshit, right? So everything I do, I can set a price point basis that. So that's why Amar was explaining to Urvija that it's the model is, it could be different models. It could be a new MSO looking to launch in India and saying, listen, can I partner with you? Can I use your infrastructure to go to markets? And here's the deal. Whatever revenue I earn, I'll do a 60-40 with you, right? That could be one of the models. I don't think we're closed in our mind. It could be someone coming into India and saying, listen, I've got to deliver X amount of services across there. Can I ride on your infrastructure that you have, your satellite infrastructure? Can I deliver these channels to those markets? So it puts a different spin on infrastructure sharing. And I completely get the reason why it's a difficult understanding for everyone right now. And as Manoj rightly pointed out, sometimes I'm so close to the forest, I don't see the wood for the trees. So I keep on talking without realizing whether someone's understood it. But the fact is, I like to kind of mention it as either an ATM that everyone can share the resources, right? All the banks everyone can go and withdraw money from multiple banks, or the telecom tower model where multiple telcos can share the tower in a particular location, right? No one has to put in one tower and another tower at the side of it and the third tower and a fourth tower. So that reduces MSO's costs, it improves the quality of service, and more importantly, allows a strong relationship in the industry going forward to be leveraged for growth. And Amar, would you like to talk about the
the commercials actually, Mr. Doshi, these are confidential matters between parties. So I don't think it would be right on our part. The revenue model anyway has been explained by Vince. So
Yeah. Yeah. So is it fair to assume, considering this Narela location example, that the more the density the location will have, the connectivity cost would be lower for MSO?
Yes.
So we have a very good right to win in a smaller town and smaller cities where the MSO would be, catering to lower number of subscribers.
Mr. Doshi, perfect. Which is why when I actually reworked my estimates from 69 million, if you recall, to 60 million, because I had a clear vision of 69 million, and then I realized there was certain pockets that didn't really work for it, right? So that's why I did 60 million, because the 60 million is multi-system operators or connected homes outside of tier 1 and probably tier 2 cities, right? The moment you go into tier 3, don't forget, rural India alone is about 109 million television households. So when you take away free dish and others, or DTH, then you're left with a sizable base. So your logic is absolutely spot on, Mr. Doshi.
Thank you. Now, couple of small more questions. So one is, you mentioned rightly, Mr. Amar, about the treasury. So I think we will be repaying debt through this right issue. And you mentioned that we have a 250 crore land bank.
That's right.
So apart from that, is there any shares of IndusInd Bank or any other treasury left, or it's more or less?
We have exited. Last March, we exited everything. And even in a balance sheet, if you see, whatever was left was classified as held for sale. And those also we've disposed of. So there's really nothing of...
What would be the area of this land and location?
So land is in Bangalore and Hyderabad. And roughly about 50 crores in Bangalore and about 10 crores in Hyderabad. 10 acres, sorry. 50 acres in Bangalore and 10 acres in Hyderabad.
Okay. And
these are all prime locations, and these were all acquired long time back. So that's how the appreciation comes in.
Okay. Now, in terms of this HITS platform, so you mentioned that we'll be, we have done a lot of capex for this setup of this infra, and now we will be getting the benefit of this. Can you give a rough number that in the history, how much we would have done the capex for setting up this HITS infra?
Yeah, the total project cost to us were about 400 crores. This happened in 2014, 2015, total 400 crores. So that, a lot of it has got recovered also with the existing business. So,
okay. And one last question from my side. So in a broadband, if I see our ARPU has come down and it's around 270 rupees. Now I understand that more and more the people will be used to the OTT platforms or more of a working from home environment. People would be wanted to have a unlimited plan, and which for maximum operator, it comes around 400 to 600 rupees kind of plan. So do you see that this 272 rupees ARPU can eventually go up because more people would want to have an unlimited plan rather than lower band plan?
So let me answer that. You're absolutely right there, Mr. Doshi. The reason what you're looking at the ARPU is that our focus is not just on the cities. We're also looking at tier 2, tier 3 and tier 4 markets. What do I mean? Which are the markets? We're looking at places like Udaipur where we have a presence, Nagpur, Baramati, etc. So when you look at moving into those markets, your ARPUs tend to take I won't say hit, but there is a softening of ARPUs and they are not unlimited plans. Those are limited plans. So what you're looking at is in fact a blended plan, a blended rate structure. So we will see ARPUs growing. In fact, there is a question I was looking at from Pankaj Mota, and I'd like him to talk also on that, is that we're not concerned because when you move into tier 2, it's like our video ARPUs. You live in the city, Mr. Doshi, you will probably want HD channels and you will want all the Star Sports channels. But someone in rural markets may take just one sports channel, right? May take Star Sports Hindi only and not cater to take the other three. So the ARPUs will be lower. So similarly, when NXTDigital, if you see when I put up the ARPUs, there are ARPUs in different DAS markets. But in broadband, we don't look at different DAS markets. We look at a blended ARPU across the base. So our base has significantly grown, but to accommodate our expansion into markets that are not necessarily prime markets, that's where we've seen a softening of the ARPUs. But you're absolutely right. We're seeing a strong transition to people wanting unlimited plans. We're seeing a transition to people wanting to improve their speeds. And as I pointed out to you, that's going to be one of the growth drivers. Don't forget, barely 2.9 million homes today are still on fiber to the home, right? So there's that kind of potential and opportunity to take it further, right? So thank you, Mr. Doshi. Much appreciated.
Thanks for the opportunity.
Thank you. Banu and Snyder, may I request?
Sir, we have few questions in our Q&A window.
Shall we go in order?
Yes, sir.
Okay. So Manoj I've already been able to understand. There is an anonymous attendee, sir. I'm not sure who this is, but if you can identify yourself, it'll be good. Be happy to answer the questions. In the meantime, Mr. Pankaj Mota, can you hear me?
We have to unmute him.
Mr. Pankaj?
Mr. Pankaj, please unmute yourself and you'll be able to speak.
He can hear me. Right. So, Pankaj, thank you very much for your question. I'm just looking at what you sent. I hope I was able to explain myself on the ARPUs. Right? So, yes. Can I go into your next question then, which was the company overall performance was backed by broadband and how we are looking at broadband growing?
Yes, sir, please.
Sure. Thank you, Pankaj. Pankaj, broadband has always been the mainstay of our business. We don't look at broadband as a separate company, nor do we look at it as a separate vertical. We look at it only in terms of having a team there for statutory and other reasons. Otherwise, the business of NXTDigital is to be a strong digital services provider. So what forms the pillars for digital services? Video, definitely, right? Data, right? Then there's, of course, voice, which we're not necessarily into, and other services like value-added services and other products that we offer in terms of our content, like shopping channels, etc. All of those are part of our digital services platform. We are looking at leveraging the opportunity, the fact that we have a strong video base, the strong hits base. How do we ensure, because don't forget, there's still a gap. We're at over 5 million in terms of video, but our broadband opportunity, our broadband base stands at over 600,000 today. So how do we kind of narrow that gap? So to answer your question, yes, we will look at that remaining and continuing to be a mainstay, as we'd like that gap to get smaller, as the joint ARPUs are obviously, as they say, the sum of video plus broadband is much higher than the individual parts. So we're hoping to keep on driving that model. We also have another model that I shared with you, which was the 100 COPE plan, right? Where we're expanding into newer geographies, newer markets. Again, we're not going in with a video offering. We're going in with a NXTDigital offering of solutions and services. So there's video, there's broadband, and there's other services that we're looking to offer there. So it's a complete integrated model that we're looking to grow. Amar, would you like to add to any of that, Amar?
No, I think this was fine. That's the finished.
Okay.
Mr. Pankaj, was that? I hope I was able to answer.
Getting you. Yes, that's satisfying.
Thank you. Mr. Ranga Prasad, good to see you, sir. Good evening to you, sir.
Mr. Ranga Prasad, I would request you to please unmute yourself and you would be able to speak.
Good evening. Congratulations to both of you all. You've done a good job.
Thank you, sir. Thank you.
I'm enjoying this question and answer section and your presentation, Mr. Fernandez. So I had a few questions. I mean, some of them I think have already been answered, but if you could go through them.
Sure, sir. Amar, I'll read it out from sir. Can you see it on your screen?
I can see it on my screen.
So the very first one, the rights issue. So you may want to explain that whole process.
Yeah.
And,
So the question is, in order to raise capital, why was a rights issue preferred over roping in a strategic investor? So a rights issue does not preclude us from getting a strategic investor, Mr. Ranga Prasad, like what you have said in your question itself. So that can happen at any point in time, and one obviously has to be careful as to what is the kind of investor you get. And this is definitely a rights issue definitely does not preclude us from getting a strategic investor at the right time. So that would probably answer your first question. Then the amount about the financial position of City Cable, we take your advice, sir, and we'll probably.
We are working on that anyway, sir. We're working on as far as possible on a strong model that eventually gets kind of integrated into a prepaid model in line with our own business. So we take your point, much appreciated, sir. Then you mentioned about the market size of shared infrastructure is 60 million. What is the target number? I shared that, sir, that over a period of time, we're looking at, obviously, over a long horizon is 30 million. Right now, we're already talking to other players, sir, several players. While the players may have an individual size, how many of their constituent customers will move to this platform is what we're working on. I promise you, sir, as soon as we have the information, we will release it. But for right now, we've kind of kept it correct, Amar? We've kept it. And what was revenue projections for this endeavor? Did we get any revenue from this in Q4? We have been a very small model we've been running, sir, for so long, because what the Ministry of Information and Broadcasting came out with the approval, Mr. Prasad, was only on April 14. So it was literally the end of the quarter. So we believe we'll see traction in this quarter, and the most significant traction, of course, in next quarter, because during this quarter is all the testing, the migration, the entire back-end processes that are happening. So all of that is currently undergoing. And Amar, how are we planning to...
Item number 4, Mr. Ranga Prasad, the rights issue proceeds would be going towards servicing of debt, the past debt, and this year also we have roughly about 66 crores of debt to repay. And we'll be using it almost entirely for correcting our debt book. Because our operations is self-sustaining. So we don't need money for our working capital or operations. That is self-sustaining. This is more a capital structure issue. As far as item number 5, 330 lakhs, I'll just give you a small example, sir. There are subsidiaries in whom we hold, say, 51% or 60%, right? So when we consolidate accounting guidelines, let's say that subsidiary has made 100 rupees profit. So we actually add 100 rupees to our profit first. Out of that, whatever relates to the share of that other partner, we remove. So in this case, for example, if 100 rupees is coming in and that partner owns 39% stake, 39 rupees is removed. That is termed as non-controlling interest, which means they are non-controlling people of the organization. So this pertains to their share. That's what we remove. And that's a combination. There are various subsidiaries which we have. Somewhere we have got 71%, somewhere we got 51%. So that goes company by company, and that's what we take out. And that's as per the accounting standards.
And by when do you expect the rights issue to commence?
So we would like to have finished it tomorrow, but unfortunately, due to various, of course, regulatory issues, everything are there, which we have to do step by step. So it will take its course, but it will not take too long, sir. That much we can assure you.
Well, you're aware that many parts of the country are going through a lockdown. Hyderabad, for example, there's a 10-day lockdown, and you might go for another 10-day lockdown. When we have a lockdown, it will be difficult to conduct much financial business. So please keep that in mind and make sure that adequate time is given.
It's a good point, sir. It's a good point. We'll keep in mind.
Yeah, I think we need to take those. I think both the points that sir has made, we need to make sure that we have there. So any other questions? Happy to do that on a Friday.
So, we had a raise of hand from Mr. Prem earlier. I would request Mr. Prem, if he still has his question unanswered, to raise his hand so that we can.
Sorry, Vince, I think Urvi, we did not complete her question.
Sorry, we'll get Urvija back. I think, sorry, I think we are getting Mr. Prem on right now. We'll do that and just go straight to Urvija after this.
Sure, sir. She was next in the line, sir.
Okay, sorry.
Mr. Prem, if you have the question unanswered, please raise your hand and I would unmute you to ask your question. Sure. Mr. Prem, you can unmute yourself, introduce yourself with your company name and ask your question, please.
Hi, sir. This is Prem Thakkar from Retail Services. Sir, you have very elaborately explained about this new PaaS platform. I just wanted to understand the costing for these MSOs, for these 60 million MSO guys. Now, I understand for the City deal, you cannot really disclose the exact thing. But like you explained, 17 rupees for one of the guys, what would be the broad range for, let's say, someone like a City or a Hathway on a per subscriber basis? Would it be as low as 3 to 4 rupees to as high as 17, 18 rupees? I'm sure you would have some idea about, on an average, the cost for these guys. So if you have done some study, it can help us understand our addressable market for this particular segment.
Sure. So let me put it slightly differently to you, right? It all depends on markets. Market to market and base to base, the price would be different. So for example, if you look at a particular MSO in Chhattisgarh, for instance, which is connecting raw terrain, the pricing there of connectivity or cost per subscriber in terms of pure connectivity could go as high to 75 rupees, could go as high to 80 rupees, depending on the how much of connectivity, and it may not even be viable to run those bases. We have experienced it ourselves in the past. We've seen where certain markets, Amar, correct me if I'm wrong, certain markets that we had a presence in, our connectivity cost was significant. And
That's right.
justify also being in those markets. What it does, this model, is it justifies being in those markets at a lower price point. It's very difficult, Mr. Prem, Mr. Thakkar, to point out each market, because like I said, it doesn't depend on the MSO, it doesn't depend on the on their business model. It depends on the location, the subscriber base, and the connectivity that they have. So even if you compare it to the competition may say, listen, I'm not interested in moving all of my markets. I think Manoj, if I'm not mistaken, I can't remember.
Density of population.
Yeah, nail on the head when he spoke about density of population. This works beautifully when you look at moving outside the tier 1, tier 2 markets, right? So the moment you go into tier 3 and tier 4 markets, where your connectivity could be in the region of 17 rupees, 20 rupees, 25, 30, whatever, this is when the model starts to make sense. And that is why I looked at that 60 million homes and said, listen, that 60 million homes, you got to discount it and pretty much look at over the next, few years. We'd be targeting about 20%, 30% of that, because already we've signed on City Networks as our partner for infrastructure sharing, and we'd look to expand that to another base. So I think the addressable base will remain. In fact, Mr. Thakkar, just to tell you, the pie chart is actually the entire addressable base. If you look at the competitors that you mentioned, whether Hathway or Den or GTPL, I don't think as a company we have anything as in not being able to offer services to them. We'd be very delighted. There's no question, because the beauty about the infrastructure sharing model is that it's pretty much for the entire industry. So the only reason why I was talking about that 60 million homes was because I know those 60 million homes are the ones today that are challenged very, very strongly by connectivity and therefore the resultant cost of that connectivity. I hope I was able to explain that, Mr. Thakkar.
Yeah, sir. That's fairly clear.
Thank you.
Thanks a lot, sir.
Thank you. Urvija, are you?
Ms. Urvi, I would request you to.
Yes.
I'm so sorry we booted you to the back of the queue.
No, thank you. It also answered a lot of my questions. So I have a couple of more questions on our cable business.
Sure.
So sir, our subscribers at 5 million, they have been stagnant, I think, for some time. So what are the growth options there? Are we looking at any inorganic opportunities, or what is your vision? Then second, I want to know on our ARPU for the cable business. I think it is one of the lowest in the world. So how do we?
India is the lowest in the world.
So yeah, India's is the lowest, but yeah, we are also, our ARPU is also very low. So how can we grow? How can we grow there? That is my second question. And also, we are reducing debt, but are there any plans to go completely debt free? I think so. Your vision on these three things?
Sure. So I'll start. Amar, I'll start and then hand over to you on the debt aspects, Amar.
Sure.
So Rvija, you kind of hit the nail on the head. So when you look at that base of 5 million, it's actually not a stagnant base. It's a dynamic base. What have we done? We've looked at video customers becoming broadband customers and broadband customers becoming video customers. So rather than just growing and trying to, throw money after discounting, etc., we've been growing slowly but steadily. We've not been growing radically. You're absolutely right. I won't disagree with you for a moment that we've not been growing radically. It's been 18% CAGR growth over the last 2 years and just 10% in the last year, right? Which, when you look at a pandemic year, by the way, is considered to be fantastic. But
how many are paying subscribers?
Yes, so I'll come to it. So there is a concept called revenue generating units, which I can share with you. In fact, I'd request someone to, it's my mistake, Urvi, I should have put that up on slide, because don't forget that there is a lot of overlapping in this space. There is our joint venture customers in this. There is our broadband customers who already have broadband within it. So when you look at it, there's a lot of overlap within it, which is why we talk about a 5 million base rather than talking about, a 6.2, 6.3 million base. So I'll come to that. But let me just explain to you first to the questions that you raised, because they're very relevant questions. So are we looking at growth? Absolutely. We believe that there is a great opportunity for growth, but we also believe, as Amar had pointed out, that the markets by and large have reached some level of saturation. However, where is the opportunity for NXTDigital? The opportunity for NXTDigital is in the markets which are outside of the cities, the rural markets. Now, when you look at those markets, those growth areas are limited in terms of the pace of growth. Because when you go to a small town, your growth factor as against a larger town may give you 2,000 customers at one time. A smaller town may give you 800 customers. So that is the reason why we're looking at launching the 100 Cope project, because we believe that there is still significant growth. But on the flip side of things, Rija, we believe that the infrastructure sharing PaaS model, that is going to be the future, because more and more MSOs are looking at how to consolidate, how to reduce costs to stay relevant in the market. So that is going to happen. You will see the base increasing. Our service base will suddenly shoot up, because every time I sign on an MSO, one of the MSOs we're currently talking to has a base of 800,000 customers. Now that's 800,000 straight away to that forms part of the service base. City, as you know, has a base of over 8.5 million. They will significantly want to move a significant base, which is in rural markets, to the platform. So when you look at the service base of NXTDigital, you'll see a tremendous amount of growth. That was the second. The third piece, you spoke about ARPUs. What I shared, Urvija, are ARPUs to us, not the consumer ARPUs. These are ARPUs that we collect at different markets. This is not consumer ARPU. Consumer ARPU is much higher than this. This is the ARPUs that effectively come to us, and Amar can explain it in detail. And by the way, our DAS 1 markets, our ARPUs are among the highest in the country today. We're very proud. And our DAS 4 as well. So those ARPUs are effectively not the consumer ARPUs, they are the MSO ARPUs that we collect. Right, Amar? Amar, you want to explain also on the debt aspects to Urvija?
Yeah. So, sorry? Yeah.
No, I think the voice was echoing.
Okay, sorry. So as far as the debt goes, our intention would be to become debt-free over a period of time. Will it happen tomorrow, day after? It will not happen. But yes, we would like to be either a debt-free or a very low debt company going forward, because that will actually give us the strength to grow in future. Because growth all requires us to have a good capital base, and that requires the debt to be as low as possible. So yes, we would like to be a debt-free company as we move along.
And as Amar, sorry Amar, I'm interrupting you, which as Amar pointed out, it's not that it's something that's at the back of our mind. It's something that we're working consciously on, right? In October 2020, as Amar mentioned, we sold the Hinduja Leyland Finance shares. That was the first step towards reducing our debt. Now we have a rights issue which will bring our debt equity ratio down from 3.8 to 1.1, right? 1.18. Then we're looking at, of course, the real estate parcels, which will bring it to sub 1. So there's a consistent and constant plan to work on becoming a company with strong fundamentals, and debt equity ratio becomes one of those key drivers that we're looking to work on. I hope that answers your question, Vijay.
Yes, sir, it does. And I've been an investor since a long time. I think I've met Amar sir also. So I would be happy if that happens. And lastly, I wanted to know if how does the geo competition affects us? So that
this is a question that has come up in the last 4 quarters since I started answering, Vijay, I must share with you. I think there are horses for courses, and each one has their own market. Each one has their own skill sets. We never see. I think we're too focused in our approach to be a competitor to the kind of geo incredible juggernaut that there is. Our focus has always been on delivering services via satellite, with a focus on semi-urban, semi-rural, and rural markets, which is where 65% of our presence is. The geo, of course, is looking at key cities where population density is high for delivering signals and services terrestrially. So I think we've got our own customer groups. I think we've got our own markets, because and it's working fine. I mean, it's been now a couple of years since it's happened. There are other MSOs also in the country. And I think we've all learned to respect and work closely, and we all have our own skill sets and our own strengths and our own markets. As I mentioned to you, platform as a service solution, I have no problems extending it to anyone, because I am a service provider. I have no problems, offering it to a competitor or to a peer or to just about anyone. So I think each one of us has a clear, as they say, horses for courses. Each one has its own individual focus. Thank you, Urvija. Much appreciated.
Sure.
Any other questions?
So we don't have any other questions now. I would request if anyone has any questions to raise your hand. We'll wait for 30 seconds.
Listen, I think you all need to be grateful that I didn't talk for an hour on a Friday evening. Okay, I think that's the reason why everyone's keeping the questions also less, and I appreciate that. But having said that, we've 1.5 hours.
Yes, sir.
Some very good questions.
No, excellent questions. I think the questions truly they challenge us to also think our whole process. May I look at closing remarks, Banu?
Sure, sir. I would thank you, and I would request you to please go ahead with your closing comments.
Sure. So, ladies and gentlemen, thank you so much for your time on a Friday afternoon. Again, I'm very glad that we were able to spend this time. I apologize if we were, not able to convey everything that we wanted to. But for that, I would request, if any of you have any further questions, clarifications, or require any data, to please ensure that you connect with the AdFactors team. And I request the AdFactors team in turn to please connect with us and keep us posted. And whatever information, it is our endeavor to get it out in the shortest possible time. So, yes, it's been a challenging year. It's been a year where personally and professionally we've been challenged on all fronts. But as they say, the great silver lining is that while we focused on the core business, the performance ended up speaking for itself with the, in terms of the EBITDA growth, in terms of the subscriber growth, in terms of the revenue, top line growth, as well as we've ended the year with a strong start to the next year, or rather I can say because we've started the year very strongly with the approval from the Ministry of Information and Broadcasting, and we're very grateful to for the infrastructure sharing of PAS model. We believe it will go a long way, not just in helping us earn a fee income and in any way, but also helping the industry, helping MSOs reduce costs, stay relevant, grow in the business. So we're very grateful for that. And I think we have our vision very clear. Again, as we keep on telling our team, at the end of the day, you've got to do what it takes to make it happen. And we believe that we will continue in those efforts. I'd like to end with, of course, wishing you and your families to stay safe in these difficult times. Please stay safe. And we wish you all a very happy weekend. Aman, I'd like you to close, please.
Yeah, sure. Thanks, Vince. Thank you, everyone, for coming on this Friday evening for this call. It's been a very fruitful conversation, and it's been a very interactive session, which we enjoyed. So thank you once again. Please stay safe, and please take care of your loved ones. Thank you.
Thank you, everyone, and good day.
Thank you, everyone. See you all after quarter one.
Thank you, Vinci, sir. Thank you, Amar.
Well organized. Thank you, everyone, from our teams. Very well organized. I genuinely get the support from our teams and Ad Factors and Access Cap and everyone else who's been there from our side on the call. Genuinely appreciate the efforts you all put in to have this done. Thank you, Snyder, Vinay, Anu, Darshan, everyone, Anand, everyone else. Thank you. Good day. Have a wonderful weekend.
Thank you, sir.
Thank you, sir.